Hey guys, welcome back to my channel. Happy holidays to most of you. I didn't want to go another week without producing another video for you guys. So here I am. Hopefully you all are doing very well. We'll talk about it on the other side. This has been a very productive week in terms of politics, to say the least. As you all already know, Mamdani and Trump, they had their first meeting. All was well. Seems like everybody kind of on the same page and agreement with each other in terms of making America more affordable again. So we shall see come January 1st if some of the policies that they talked about behind closed doors will be implemented in our New York. So we shall see. So in this video, I want to talk about Fannie Mae dropping the credit score rule. Now, I totally get it. There's two sides to this story. Dropping the credit score will actually allow more people to enter into the space of getting getting an affordable mortgage. However, this is hypothetical. This is what I'm thinking. When you drop the score, you're also going to get people who may or may not, and this is an assumption, may or may not be financially responsible. Now, there are some people who they may have a low credit score now, but in the future, they plan on getting their credit score better because they've learned they made a mistake and they don't want their mistakes to cost them money now. So I understand the two sides of the coin. One, you're trying to reach more buyers, and then the other side is that they may not be financially sound in the moment, but they're working their way towards financial stability. So two can, we can look at both options, but generally speaking, and then there are the people who have a great credit score and they're very financially irresponsible. There's that. But let's see in this video why they chose to drop the score.
A new home. As of November 15th, mortgage giant Fannie Mae has scrapped its minimum credit score requirement of 620. Now, this move could potentially allow more Americans to qualify for loans from lenders who review borrower information through their current underwriting systems. This expansion also gives new opportunities to borrowers with so-called thin credit files or non-traditional credit histories. Here with us now is Bobby Rebell, a certified financial planner and the consumer finance expert at badcredit.org. Bobby, welcome. Good morning.
Thank you for having me.
We were talking about this yesterday. This is pretty big news for those who have always dreamed of being a homeowner but just misqualifying through Fannie Mae. What is changing here? What does this mean for so many consumers out there?
Well, you're absolutely right. This is a big deal because a floor has been removed. So it used to be sort of an up or down vote. You're in or you're out, 620, that is it. The difference here is now they're going to take a more holistic approach, and that's going to be more inclusive, as you mentioned, to people who maybe have a thin credit file, who maybe wouldn't qualify with just the hard stop at 620. Now they're going to look at other factors. They might have to have a larger down payment. They might have to have more cash reserves. It's not necessarily, this is important though, it's not necessarily a change in the underwriting standards. You still have to be.
I'm glad they said that. So this is actually, I like their proposal for the new adjustment. 620 could be required now instead of the 680 standard score. They're not automatically rejected anymore. They're looking at more asset based. So how much you are willing to put into down payment, how much money you have in reserve. These are some of the things that I alluded to in the beginning of the video, that there are other factors, because sometimes people, they go through, for example, what really hits people's credit score are divorces, unfortunately. Once you get a divorce, your credit score goes down in the tank. As many people would attest who've been divorced. So it's very difficult if you're trying to start your life over and you're starting at a very low threshold. So I'm glad that Fannie Mae is adjusting to the economic conditions of today, because people have a variety of different scenarios that may exclude them from the buying market. So I'm glad that they're on top of this and they're shifting it in a way to in a positive direction that is in favor of the consumer.
A good risk for the lenders.
Yeah, I was wondering about that. I'm sure it's a lot more than just the credit score changing. What kind of impact could this decision have on the housing market, Bobby?
It could have a huge impact because, we've got such a tough time for people who want to become new homeowners, and this is something that can really open up a lot of opportunity for them to get the financing that they need to get into that first home. People that don't have a long credit history, right? It just might be as simple as they haven't been alive that many years to have developed a long history of having credit and having.
When she said that, they may not be alive long enough for them to establish credit. I believe they're trying to target Gen Z, not Gen Alpha. Gen Alpha is still too young. I think they're like 18 years and younger. But their demographic, they're trying to target young home buyers because they want more young people to be invested into real estate for a much longer period of time, which makes a lot of sense, right? This is encouraging people to not only be home buyers in some scenarios, like having families.
That bigger file to look at, right? So this is going to allow them, if they have other resources, if they're good employees, if they pay their bills on time, different things. It opens up the door to borrowers with lower credit scores. And you don't always have a low credit score because you did something wrong. It just may be a question of the circumstances, the things that you've been doing in life. Maybe you've been a student. Maybe you've just been doing other things that haven't necessarily focused on building that one.
The students who go off and they're like, I want to do my academic year in Spain, or I want to go study abroad for 3 to 4 months. I'm not really thinking about buying a home right now. I just want to experience the world, travel, yada yada yada. This is what they're talking about. So they're trying to give people an out, like life experience. They may be more focused on that. And then later on, they'll consider buying a home and entering into the whole mortgage thing.
Super important. I don't want to call it a little number. That big number, it's important, but maybe that just hasn't been something that you've been able to do.
Yeah, a lot of people have thin files, as we said. They just don't have credit cards. What is this?
Oh, they have credit cards. Trust and believe. They have credit cards and they use it all the way up. This is why consumer debt is in the trillions in America, especially in America. So they're using the credit cards. I think what they're talking about is those who are trying to be financially responsible at an earlier age. They're putting money towards the down payment. Maybe they were gifted money from an estate, like, a mother, grandparent, or something passed down money to them. And so they're able to financially afford to buy a home. Yeah, we want to make room for people like this.
Mean for potential home buyers?
So it is good news because it allows you to present a bigger picture of what you bring to the table as a risk to the lenders. At the end of the day, Hannah, what it really comes down to is, are you going to pay this money back on time and as you are on schedule and all those things? So are you a good risk for banks? So they're going to be looking at different things. They might be looking at your credit history. They might be looking, for example, at your payment patterns. Do you pay your bills on time? Your debt to income ratio is something also that people can focus.
People overlook this a lot, and I don't tend to emphasize on credit score and credit history on this channel per se, because it's not necessarily finance, but we do talk about it. But payment history is very, very important. It's not just about having the perfect credit score, but you want to make sure that people see that they can trust that when you're lended debt, you can pay it back on time, in full. You're not carrying over a balance, yada, 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 etc. So that's really important for them to see certain pattern and certain financial pattern behaviors, because that's also going to pay off when you're going for a mortgage with any one of the banks. They're going to look at your payment history. They're going to look at your track record of having full employment. We didn't even touch on the fact that when you are purchasing a home, you need to have 2 solid years of full-time employment, like either W-2, or if you have your own business, you have to show a consistent profit margin. So these things are very important, other than this credit score that they didn't even talk about, that will impact your ability to obtain a mortgage.
Focus on making sure that that is, looks good, that you don't have so much debt relative to how much you earn. It also means that they can look at things like non-traditional credit references, documentation. Are you employed? Does your employer have something to say that you're going to be a good credit risk? And I love this last.
I literally just said that, but I didn't talk about your employer being a reference letter for a mortgage. But yeah, all of these are factors. They're looking at financial factors. It's very, very important.
Last thing on this graphic here, home buyer education. This is something that is so essential because people think that, owning a home, you just buy the home and then, that's sort of the end of the story. There's so much that goes on when you own a home in terms of insurance, in terms of maintenance, in terms of maybe you might have HOA, homeowners association dues, maintenance of the exterior of your home, things that go into it that people don't think about till they're in the home. And
maintenance of the interior of your home. It depends on what type of home you're purchasing. Are you purchasing a turnkey? Are you purchasing a fixer-upper, a rehab? Are you planning on using this as an investment, as an Airbnb or some sort of short-term rental? Financially, it is like the mortgage is just the first step. Everything else is just step A through Z.
So homebuyer education is something that I think could really be an asset to many potential home buyers.
Yeah, speaking of home buyer education, what are some tips for people wanting to make themselves the best candidate for getting a loan?
Yeah, make sure you are first and foremost paying all of your bills on time. It's not a bad thing to try to boost that credit score. It's only going to help you lower those credit card balances. That is one way to get to a higher credit card score. We mentioned your debt to income ratio. That is also something that you can control. Boost your savings. The more assets you have in the bank, and I know this is a little bit counterintuitive.
Boosting your savings, paying down your debt, all of that is dependent on you getting a job that pays good money. And good money in this climate can mean a lot of things. You need to have a salary that when you pay your bills off and then you take care of your immediate needs, whether it's housing, food, utilities, you need to have extra money on the side, like a couple of $1,000s on the side that you can put aside. And by the end of the year, it's a substantial savings amount. And I know I'm kind of speaking to an audience in New York City where it's virtually impossible because things are extremely expensive here in this state. I totally get it. I'm in the same boat as you guys as well too, because the overhead is extremely high in New York City. But it's not impossible, right? There are little things that we can do to budget ourselves, or if we are anticipating purchasing a home in the near future, and looking at our credit score as, hey, this is a metric that I may need to meet in the present time. Let's say you're in the dumps, in a 500 or less credit score. Yeah, take 2 to 3 years to get it fixed. Get a good job or get a couple of side hustles that will be able to afford you to pay down your debt and save money. There are different ways that you can do that. We're living in an age where social media, the internet, and there's a plethora of different resources that's out there that can help us to achieve those goals, right? Even in a tough market such as New York. So they're trying to make it very possible for us to do it. So why not do it?
Because you might say, well, I wouldn't need to borrow so much money if I had the money. But you want to have a lot of assets in in place, because what you don't realize, as we mentioned, is that once you own the home, there's going to be a lot of expenses that you're going to incur, and the banks know that. So they want to see how much of a backstop you have when you get into the home, so you don't have trouble if you have to replace the windows, if you have to replace the roof, if maybe your insurance is a little bit higher than you would like it to be, which is always the case, right? And then, of course, check for errors on your credit report, because that is the easy, well, I don't want to say it's easy to fix, but that is something that can be fixed and can boost your credit score. You never know. Mistakes are made.
Thank you for
Yeah, mistakes are made on your credit score, but beware of those credit card companies or those credit repair agencies that promise you the world and promise you that they'll remove X, Y, and Z off your credit, and it doesn't happen. I'm just gonna be honest, like it's not always the case. Sometimes they just take your money, and with time, the same amount of money that you're paying these credit repair agencies is money that you could have been putting towards debt. So just be very cautious about doing business with some of these repair companies. So that's it for this video, guys. Now is actually a great time during the holidays to really take a look at the inventory, what's out there in your respective neighborhoods, and see where you would potentially want to purchase a home. And by the time spring rolls around and it's nice, then you can start shopping for your homes and, you know, put a down payment in there. Have a wonderful Thanksgiving, guys, and I will see you in the next video.